D. Arulselvan, the Executive Vice President and CFO at Cholamandalam Investment, joining in on the show right now. Mr. Selvan, thanks for joining in. Just going through your numbers, your NI has seen a good growth of about 25%. Well, the profits remain flat, mainly on account of DTA. Given the current economic backdrop, how is it that you would classify your second quarter performance?
The performance from asset growth perspective with regard to vehicle finance, which is our mainstay, has been a little slow. Factoring in the industry degrowth that has happened. However, as we have a bouquet of products, what has happened is while we have slowed down considerably with regard to the heavy commercials and to some extent on the light commercials, we have been able to maintain at least a growth number. Actually, the vehicle finance business grew by 3% in disbursement, while asset growth is still seemingly at 23%. That is because of the accumulated growth over the last few quarters. We are confident that it will turn around. We are seeing some traction already happening in October during this Deepavali season. And also on the cost of funds factor, what is happening is we are finding the cost coming down because the MCLR of banks have come down a bit, and we are glad that we will see some more improvements on the NIM side as we go along in the coming quarters.
One of your mainstays is vehicle finance, especially commercial vehicles. That's where the problem is. Are you seeing any uptick, any recovery, and are you confident that second half it could be better?
Yes, we have a huge reliance on commercial vehicle, but we have also de-risked ourselves by moving on into other areas of vehicle finance like cars and MUVs, two-wheelers, tractors, construction equipment. And in such a turn, the used business goes up. If you see our presentation, you will see that our used business has picked up in this quarter, and we were able to do better business in this segment. So we are able to, that's how we are able to sort of offset the reliance on a single sector of this vehicle finance business by itself. So this helps us to sort of offset any, both on the growth side as well as on the profitability side, to make sure that we keep our business chugging along at a steady pace.
At a time when interest rates are nearing the end of the rate cut cycle, 25 bips, 50 bips, that's the max what we will get. I'm assuming that a year from now or 18 months from now, the cost of borrowing could be incrementally higher. So how are you preparing your asset liability? Are you right now borrowing short and lending long, or you're not doing that?
No, we never used to do this borrowing short, lending long business, because if you have seen across all the cycles, whether it is pre-ILFS or post-ILFS, our short-term borrowings have been less than 15%, which is what our asset profile allows us to do. And all through, we have been also sharing our asset liability statements even over the last more than 20-25 quarters, and you would see that across all this period, our LM has been matched without any negative cumulative mismatches. As a matter of fact, even after all this, when RBI has now come up with the new guidelines yesterday, allowing up to 10% negative mismatch, we internally follow no negative mismatch across all buckets. Coming to the question on the cost of funds, what you are seeing is the repo rate reduction cycle. What is happening is the MCLR reductions are happening, and most of the long-term borrowings have a 1-year reset cycle. So we will see the resets happening mostly in Q3 and Q4, more predominantly in Q4, because if you again see the trend, our bank borrowings were very high during Q3 and Q4 last year, when the market, there were a lot of pressures and there was no market borrowings available, and everybody had to rely on bank borrowings, and our bank borrowings also went up in this period. These loans are coming up for reset in the coming quarter, in the current quarter and the coming quarter, and you will see a lot of resets happening at much lower MCLR, which will sustain for another 1 year. Because the MCLRs are currently running are lower than what it was 1 year back. So you will see that. Also, on the shorter end of the CP levels, the rates have really crashed, and we are able to do CPs at sub 6 levels also, and so we see that as a fair mix. And last but not least, we are also experimenting, and we have done quite a bit on the overseas funding. While at this stage, overseas funding is as good as, if not slightly higher, if you take the withholding tax also into account, costlier than the local borrowing. We still see that as an opportunity and a necessity, because to diversify the investor base. We will be pursuing this over the coming quarters.
Address the asset quality as well, because if one really takes a look at how your NPAs have performed, one wants to understand really what would be the trend going forward, because there has been an increase in your NPAs. Your gross net NPAs were up by a good 8% on a sequential basis.
No, on sequential basis, yes, there has been a marginal increase, but on a year-on-year basis, there has been a reduction. See, if you see across all the periods, again, if you go back any year in the past also, you will see that normally Q3, Q4, the NPAs come down, and in Q1 it bounces up a little bit, and Q2 it sort of stabilizes, and then on it moves on to again come down. So this is like a cyclical thing, because in any business, the Q4 is always very focused on very high performance across parameters, and people try and push down. The key to measure is to see whether last year same quarter versus this year same quarter, are we really being pushing it down. Again, compared to many others in the industry, our NPA numbers who are in similar asset category, our NPA numbers are fairly robust, and I would say, and our provision coverage is also fairly adequate, and you will not see a lot of swings in either on the NPAs or on the provision coverages, which sort of demonstrates that our asset quality as well as our provisioning basis has been fairly consistent over this quarter.
So, and what would be the guidance going forward as well? Do you see further consolidation? Do you see your market share increasing on the back of that as well going forward?
Yes, if I take October as a benchmark, yes, that's market seems to have sort of come back. Again, if you look at it, last year, first 2 quarters were very high growth quarters. Against this, the first 2 quarters of this year seem to be highly negative. And last year, the third and fourth quarter were very moderate quarters, if not low. So against that, even a normal performance would look better. I'm talking about the industry, not Chola. So because of that, the industry growth will be higher, and Chola will also be performing better. We also still see a lot of scope that the BS6 conversion will force a lot of pre-buying in the BS4 models before the end of this financial year. And while there could be certain amount of hit taken by the auto companies by giving higher discounts to dispose of their stock, as long as we are funding the borrowers at the net discount prices, we see that as a good opportunity to scale up our disbursements, and we see that will be good traction. Also, the monsoons have been fairly good, as in some places it has been a little higher, but I think overall the crop season would come with good results, and that would push up the rural demand, which is where our focus is. And so we see that also giving good traction.